Hey guys, coming at you with another video. Today I'm going to talk about the 2020 Berkshire Hathaway annual meeting, which is the first time actually that Warren Buffett has spoken since this whole COVID-19 crisis has begun. Since the pandemic was announced, he's been pretty silent. He hasn't really done much in terms of giving people any reassurances, any updates as to what Berkshire Hathaway, the company that he runs, is doing. So this was quite a time. So the original video I think is like 5 hours and 5.7 hours or something long. I watched all of it last night, and I'm going to give you my top 5 takeaways, as well as a little bonus right at the end there. Something that I was thinking about already while watching the video that he actually verbalized just right at the last question there. So I think you'll get a lot of value from that. So the meeting started out with Warren Buffett sharing a little story. So he was sharing about basically the history of America, going back to the 1700s when America was originally founded, and he was talking about what had happened since then. So it is somewhat remarkable in terms of the progress that America has made. What he did is he calculated sort of the value of America using the land value that I believe Louisiana was bought by America from the French. And then he sort of extrapolated that to kind of get a ballpark of what America was worth back then. And he kind of came up to this approximate amount of $1 billion. So that was in 1780 something, right? And as of today, either before or after the COVID crisis, there was an estimate by the Federal Reserve that the total wealth of America was close to $100 trillion. That's all the houses, all the companies, all the businesses, all the retail stores, basically all the real estate, right? Just everything put together was about $100 trillion. So that's a 1 to 100,000 increase in terms of the wealth of America over this 230 odd year period. So what he was trying to share is that even though the wealth in America has increased by this amazing amount, the journey was not just a flat line up. So during this time, it experienced many crises along the way. So one of which was the Great Depression. Another was the Civil War. So to give things into perspective, the Civil War, 6% of males between the age of 18 and 60 were estimated to have died during the Civil War. That's 6% of the working male population died within a 4-year period. The 1918 influenza pandemic, 0.5% of the American population died within those, I believe, 3 years. So what he was trying to point to was that so far, even the worst case potential for COVID-19 isn't quite on those levels in terms of deaths. Definitely the economic impact is going to be there, but the actual number of people that die as a result of it, while it is unfortunate, it is not to the level that America has seen in the past. So he was trying to point to that we've actually gone through other crises that have been quite significant. And he even brought up the Great Depression. So in 1929, that was when the stock market started its largest decline, right from peak to the bottom. It was a 90% decline in terms of the stock market prices. And he brought that up as well. So definitely there were bumps along the way, but he reiterated the point that you should never ever bet against America in the long run. He also said that he doesn't know what's going to happen next week. He doesn't know what's going to happen next month, even next year. So he's not making any predictions of any kind that we're going to have a smooth ride. It's going to go down. It's going to go up. But what he's saying is always stick to the long-term fundamentals that America as a nation will come out ahead. The interesting thing to watch in terms of what he's been doing so far, he has not made any major purchases in March, right, during the start of the COVID, or in April. Berkshire Hathaway started with about 130 billion in liquid, either cash or US treasuries, and they've not spent anything major either in March or in April. And actually he has sold off his entire stake in the US airline. So he owned about 10% of the 4 major US airlines in America, and he's actually decided to sell them off. And what he decided was, due to the pandemic, he does not know what the next few years hold for these airlines. And due to the terms of the bailouts that these airlines have received, where they have to give stock options to the government at these current low prices, he felt that the upside was no longer what he was expecting from them, and there was considerable downside. So he's actually sold off his entire stake in all 4 airlines. So that's the only major changes he's done. But even relatively speaking, in his portfolio, the airlines were worth about 6 or 7 billion, I believe. So at the end of the day, it was a tiny fraction of his company's net worth that they've sold off. So the majority of their businesses are still owned. They're not selling anything. They're not making any huge restructurings. Other than that, there was a lot of questions where he's answered even before. The few things that have come up that, again, more recently as I've been studying more into personal finance, it's come up again and again. And one of the things he mentioned was, if you're an average investor, investing in an S&P 500 index fund is likely going to outperform any active managers. And he reiterated this again, to the point he was saying that, even if you had the money to invest into hedge funds, into like all these special investments, putting your money in a simple S&P 500 index fund and just holding it over the long term, you'll probably do better without paying any fees and just holding on to essentially the growth of American business over the next decade, 2 decades, right? He did mention something interesting which has made me shift slightly in terms of what I am thinking of doing with my own investments in index funds. He did mention that oil companies do have some downside ahead of them, just given the current oil prices. We don't know how long it's going to last, what the upside is going to be. So from that perspective, I was planning on investing into the Canadian Total Stock Market Index Fund, but I'm going to reduce that slightly and put more into the American Index Fund, just because the Canadian index has quite a high percentage of oil companies that compose the index, which are being hit pretty hard. So in a weird way, it's a good time to buy. However, there is some downside that you can't really foresee fully. So just to diversify, I'm going to still keep putting a little bit into the Canadian and start to contribute more into the US index funds. The other thing he mentioned, credit cards. Don't have balances on your credit cards if you're trying to invest. If you have money, you're paying 18% on your credit card, pay it off. Don't try investing. It's hard to make 18% consistently, but paying off your credit card, you're reducing an 18% plus interest rate in many cases. Finally, the bonus tip. This is something I was thinking about even as I was watching his video. Intelligence and IQ are on one side and wisdom is on another. So you can be very smart, very intelligent, come up with these amazing schemes on how to make a lot of money, but there is a lot of wisdom that comes from simplicity and from experience. So many of the things he says, he's very conservative. He's very, he doesn't take a lot of unnecessary risk. He stays away from leverage with his investments. And one of the reasons is he's gone through so many of these cycles, so many of these bumps in the road. He knows when you do these complex schemes and you start messing around with a lot of investments that have so many moving parts that there's a lot of downside risk in extreme circumstances. So he's very aware of that, and he said many times he would rather hire the CEO that has more wisdom than IQ. So I hope you found this helpful. If you have any questions, feel free to comment down below. Until next time, all the best.